We're now going to head into the business of consumer protection, which has gone through very many different phases in this country. And one of the things I don't tell many people is that when I started at the OCC in 1976, my job for the first year and a half was consumer protection. I wrote and handled matters under truth in lending, equal credit opportunity, home mortgage disclosure, RESPA. I worked on the task force of the various agencies that wrote those regulations. And I remember the first time I was asked to handle a consumer complaint. I had been in the agency about 22 minutes, and I was handed a consumer complaint against Citibank. And I remember the bottom line of what I did. I wrote a 18-page letter to Walter Wriston, who was the chairman and CEO of Citibank, saying that he had violated the Truth in Lending Act because the disclosures on the Citibank credit card form was not 10-point type. And I thought I had really hit the big time here. And I often wonder now about Walter Wriston getting that letter. Of course, he never saw that letter, but getting a letter from some dopey attorney at the OCC saying his disclosures were not 10-point type. And at the end of my tenure and looking back at that, the conclusion I drew was that for all of the enforcement and all of the mechanisms we have in this country that people need, what they need more is financial literacy. If they had the capacity to come out of schools, high school or college, and know how to protect themselves, we would be 50% further on. But unfortunately, we're not there. So the question we have to answer is, how in the world do you protect consumers from bad financial things? How do you protect them from themselves? I mean, the problem is you can't stop them from doing dumb things. And unfortunately, a lot of times, that's what it comes down to. So we've got a terrific panel here this morning to talk about the future of consumer protection in this country. And on his way here is Rod Alba. He's not here yet, so we'll cover for him until he gets here. He's Senior Vice President, Mortgage Finance and Regulatory Counsel at the American Bankers Association. We've got Brad Blower. Brad, raise your hand. From Inclusive Partners, LLC. Kelvin Chen, who's been with us before, Senior Executive Vice President, Head of Policy at the Consumer Bankers Association. And to my right, Adam Rust, Director of Financial Services, Consumer Federation of America, and JP Alfred is back to help moderate this panel. So Kelvin, I want to start with you. We obviously know where we are today with respect to consumer protection. It's going through yet another set of changes, which I will describe as neutrally as I possibly can. If there's a shift in administrations in the future, what are we going to see happen? What are the policy changes that are going to be affected? And are we going to be going through this whipsaw effect back and forth?
Thanks so much, Tom. Certainly a whipsaw, certainly a pendulum. But the thing I struggle with is how the toolkits will change. So, it's not lost in anyone in the room that post-Celia law, the CFPB, as well as a lot of the other agencies, will now be extensions of the executive, right? And so when we, in first generation CFPB, made a point of distancing ourselves from the White House.
Yeah, can we turn the volume up a little bit?
We now see a CFPB in the last two administrations that's been attached at the hip with the White House and furthering that messaging. But we also now see with things like the most recent corner post developments and the litigation challenges that we're seeing on rules, a move away from the traditional toolkit for policymaking towards more, the best way to say it is more nimble tools, but more clumsy tools at the same way, right? So you have more use of the bully pulpit. You have more use of naming and shaming in ways that cuts a lot of corners that for all the protections that we would expect from the APA. And if you'll indulge me, the one example that I'd use here is, I think for a couple million Americans, the first time they heard of the CFPB was when Mark Andreessen went on the Joe Rogan show, and Joe Rogan said, "What is the CFPB?" And Andreessen said, "It's this political body that does whatever it wants." And it's a really, it was a really curious question. It's like, how did Mark Andreessen get this impression of the CFPB, and how does he know of it? If you rewind the tape and go back to the CFPB's enforcement complaint against LendUp, which is a company that Andreessen Horowitz funded, they claimed to have shut LendUp down. It was a consent decree. LendUp was already shutting down the credit card operations, but the CFPB took credit for that. I get that. But in the CPB press releases, there's always a big headline and a tiny headline. So the big headline was them shutting down LendUp. The middle headline was them naming and shaming A16Z, Kleiner Perkins, and Google Ventures. None of those entities were named in any of the pleadings. None of those entities were named in the complaints, much less the enforcement, like the consent decree. Yet they just got dragged through the streets and tarred and feathered, right? And so Andreessen was kind of justified in thinking that he didn't have due process of law and it was subjective. As we move into this new era of consumer protection regulation, it's hard to imagine that we won't see more of that or more moves into things like examinations, which will also be hidden away from the public eye, and I'm not quite sure what to do with that.
Thank you. For Brad and then Adam, if and when there's another shift in consumer protection regulatory structure, should it treat fintechs, banks, and credit unions the same, or should banks have a higher standard?
First of all, thanks for including a couple consumer advocates here in the panel. Appreciate that. And I'm glad the question is actually phrased when and how, and not so much if consumer protection should be reconstructed. I do think that, in my background, I've worked both as a banker at American Express as head of fair lending, and then worked for the FTC and Justice Department doing civil rights and consumer protection work. So looked at it from different perspectives and worked for nonprofits as well. I do think there is a greater responsibility at chartered institutions. It's kind of like that DC comic or Marvel, I forget which, with great power comes great responsibility, with Spider-Man, you know. When you're given access to discount windows, when you're given federal insurance on your assets or on deposits, when you have access to federal rails, I think you do have an additional responsibility to give back to your community, to ensure that your compliance standards are up to snuff. But I also think we need to raise the floor a bit more so that there aren't blind spots in the financial community. We need to even out the playing field so it's not just the chartered banks that have these responsibilities. Fintechs, I think, also need to step up to the plate, and things like the Community Reinvestment Act should apply to them as well. I've been an advocate for that for a while. There shouldn't be these sectors of the economy that are kind of have less skin in the game in terms of the communities that they serve. So yes, I do think that with charters come great responsibilities. I am a little concerned in the current deregulated environment that there are going to be a slew of financial entities that get ILCs that come with very few responsibilities and a lot of benefits at the state level. And so I'm concerned that we have a little bit of a race to the bottom potentially in the current environment. I think self-regulation works to an extent, but you need to have a strong enforcement and regulatory community as a backstop. And so the banks have an opportunity now to have a couple of years to really get their ducks in a row, to do the right thing, to demonstrate that they can meet their responsibilities that come with chartering. So that would be my initial response. Adam.
So actually, I'm going to agree with Brad and not go into great detail on the point that a banking charter is a privilege. So that's a fact. And I also wanted to just emphasize that I think it's great when we can get together. An environment like this is well utilized for cross-sector conversation. We all work kind of in our own silos, but this is a great chance to engage and collaborate and hear each other. So on this question, I think obviously fintechs have expanded and grown and are becoming a larger part of our economy, and the pandemic only accelerated that. So the question was pressing before, but now we have a new administration that's really bringing that to the forefront, and that includes bringing fintechs into the banking perimeter, right? So we are all aware of the chartering that's going on right now. This will be an interesting moment because fundamentally the cultures of fintech, that's about break it and then ask questions later. Banking is the opposite, right? Bankers worry about problems beforehand, and that's great. So how will these cultures blend? I am worried about that. I think the track record we've seen when they try to work together, principally through bank-fintech partnerships, hasn't always been smooth. There have been cases where one side says that was someone else's fault. I'm thinking of the Synapse debacle, where they weren't even doing standard ledgering, right? That's a real concern. I think this will play itself out unfortunately, in probably the most concerning consumer protection problem we face today, which is scams. I think when that starts to become something that moves into the banking system, but it's being performed by institutions that are used to playing fast and quick, that we could see some problems. And specifically, I'm worried really about small business fintechs that are getting charters. You know how easy it is to incorporate, how easy it is to get an EIN, and from there, how easy it is to get a banking account, right? I see structures that we'll see scenarios where scammers are creating businesses and either running payroll to those bank accounts or paying themselves through unusual mechanisms, Airbnb, for example. Who would think of that? But that kind of mechanism is going to open itself up, and that will end up leading to more scams.
So I want to thank everyone for being, I want to thank you guys for being here. And in respect to the question you raised about being here, Bob Ledig back there put together all these panels, and I want to thank him for a great job here of putting together these fabulous panels. But one of the things these panels reflect is sort of our view about decision-making in the dialectic method. I was a philosophy major in school. I believe in the Platonic dialectic method, meaning when I was litigating, I learned an interesting lesson. Every time I filed a complaint, I said, this is an overwhelming winner. And every time I got the answer, I said, we have an overwhelming loser. And therein shows you the fact that it is conversation and discussion and debate that produces the right answer. And that's really the underlying format for some of these panels. So again, thanks for being here. Rod, I'm going to turn to you, I guess as the only banker on the panel. We've seen, obviously, a different agenda from this White House. You could call it deregulatory, you could call it whatever you want, but it's going in a different direction. Some would argue that's the right direction. Some would argue it's the wrong. Where do you think this is going? Is it going to stick? And what are the guide rails that you think we're going to have in this new administration for consumer protection?
Yes, thank you, and good morning, everyone. You know, it has been an interesting year, Tom, and I think there's been a lot happening. Let's simplify the conversation, and let's call Mr. Trump a deregulatory agent. Okay, so the industry has been going through deregulatory moves. If we can simplify it to that, I think then we sort of understand where we all stand. And we at the American Bankers Association, we do believe that there has been over-regulation and certainly over-complexity in the regulation, which is different perhaps than just over-regulation. I think that the regulations and the regulatory bodies are just simply confused and mixed up. They are a pretzel. You don't know how to detangle some of the requirements that we have upon us. I spend hours upon hours with about 3 or 4 other staff members that may be in this audience just trying to handle questions that our members throw at us. So we have to simplify. We have to bring it back to reality. There's just been too much of an accumulation of laws that are just simply overlapping. And that really does affect entry into markets. And certainly in the mortgage space where I specialize, we are seeing that banks are not only leaving the space, but just not entering. They're staying out. And until we clean this up, I think they will stay out. But more importantly than that, I think, is the other side of this coin, which is, believe it or not, the American Bankers Association has said to the Trump administration, stop, don't cut, don't simply remove regulations. We don't need to just grab regulations and burn them and take whole segments of regulatory bodies and just throw them to the trash heap. What we need to do is go in and dissect these regulations and engage in surgery so that we can take away that which is harming our ability to serve our communities, but we can still protect consumers. That is a much, much more difficult task than simply pulling regulations, Tom. As you know, we need these protections. We need consumers that understand what they're purchasing and what they're buying. However, the sort of the fat in the additional compliance and I guess the punishment side needs to be simplified, it needs to be regularized, and it needs to be better understand. We have to have a better understanding so that we can better serve our communities.
Thank you. Kelvin, when thinking about consumer financial well-being, how should policymakers define what consumer protection should be in the digital age? And I kind of have a related question, which is maybe peripheral. To what extent do you consider consumer-directed fraud not committed by an institution, financial institution, but looking like it comes from a financial institution, part of consumer protection?
Oh, that's a great set of questions. If you don't mind, I'll try to bifurcate them while also trying to be kind of succinct. On the broader question of how do we think about consumer well-being and consumer protection, in the early days of the CFPB, I love the idea of this discourse and coming to an answer, Tom. In the early days of the CFPB, we had these cross-disciplinary teams, economists, rule writers, market experts, and we'd beat our heads against the wall. And usually, late in the night, someone would say, gosh, this would all be easier if we were trying to fix consumer protection rather than trying to fix poverty, right? And so, one of the things that we've seen now is kind of whether or not the CFPB views fixing affordability as in its remit. And post-Celia law and with the politicization of consumer protection, it sounds like that'll be the case. The problem is that these are pretty clumsy tools for doing that, right? Like we spent the last administration going to war over credit card late fees, right? So that went to Congress, that was in litigation. The CFPB's Card Act report showed that the average credit card account has 0.9 late fees per year, right? So all of that, if the CFPB had been successful, meant that you would have saved consumers $24 a year, and maybe 72, assuming that consumers have got 3 cards. And they did very little math about the impact to people's access to credit and what that could have done for their financial health. We have the same thing right now with this 10% rate cap, where Brian Shearer's paper has made the rounds. It's very popular to talk about it, but by his own math, if you just open it up, he would cut off access to credit for all consumers that have below an 800 FICO score. Right, so all that's to say is that if we're going to do this affordability thing, if we're going to try to fix poverty with consumer protection, we've got to be a lot smarter with how we're doing it. And so I think that means that we've got to be kind of go back to CFPB 1.0, where Raj Date was hiring MBAs. Raj himself was at business schools recruiting MBAs into the CFPB. You had market experts at the table. You had a sense that products were part of the solution, and then you also had real empirical rigor about the impacts of the regulation on people's access to products that will otherwise be shock absorbers for them when they handle stresses outside of their financial lives. So that's that first part. JP, on the broader question of kind of how we think about scams, is that kind of the best way to kind of restate
yes.
it? So the question here, right, is like, if I can restate the question, I think the hard version of it is, why do banks not refund consumers for scam transactions? Is that the tougher way of asking the question, or?
No, not scams from financial institutions, scams that look like they're coming from financial institutions, and these type of scams are more and more rampant, and whether you consider that issue part of consumer protection.
Thank you. That's a much nicer question, we certainly think that's a consumer protection question. It's not something that's necessarily, the hard thing about it is who's on first for that, right? I have a friend that's a former enforcement person at the FCC, and I regularly take him out to coffee and ask him the same question, like, is call spoofing illegal, or is it just really poorly enforced? And I think it's the latter. And by call spoofing, I mean that you can get a call on your phone that'll show up as JP Morgan Chase saying, this is JP Morgan Chase, XYZ, please give us your information. And for most consumers, that'll look and feel like a bank transaction, right? And it's bewildering to me that there hasn't been action on this. And so thankfully there was a hearing in Congress about this, I think 2 weeks ago, where we had a witness up there. We have one of the witnesses here as well. And this is an issue where we really think that we can work together to fix some of these hopefully low-hanging fruits, like why can't we enforce those laws?
You know, if we thought consumer protection was tough before, with what we're seeing with AI, deepfakes, and the amount of criminality that's increasing online, it's going to become more and more difficult because, as JP suggests, it's going to be difficult to know if what you're seeing is actually what you think you're seeing, and what you're hearing is actually what you think you're hearing. And so the business of consumer protection is going to get a lot tougher than it's ever been. I want to come back to you, Rod, and before you sat down, I mentioned that I spent the first year and a half of my career at the OCC dealing with truth in lending, RESPA, home mortgage disclosure, ECUA, and that I had concluded that the balance between writing rules and spending money on protection and consumer literacy was out of whack. Are we ever going to get to the point where we can deal with consumer literacy so consumers can protect themselves? Because a lot of the pro bono things I did in practicing in private practice had to do with helping people with those kinds of issues, and they knew nothing about nothing. And you know, you say to yourself, how do we give these people the ability to protect themselves? And then from the other point of view, how should the regulators look at this in terms of guardrails moving forward for what makes sense as a rule and what doesn't?
Yes, fundamental question. Fundamental question in a point where, you know, we're looking at AI, for example, or digitalized systems, and we're within this group of lawyers and with consumer groups, we're looking at how do those new technologies change the bank? How do they change the market? So that's an interesting question. What we're not necessarily focusing on is how are they changing the consumer? How much more educated is a consumer today under AI systems than they were before?
Or uneducated. How much more uneducated?
Or how much more uneducated? How much more can they be fooled? So do we now have a circumstance where the disclosures that we have to give on all the types of products that we sell in the market so as to create good competition, do those disclosures become more important or less important? More important in the sense that they have to give out precise costs, less important in that consumers may be becoming more savvy. I think that this is one of the great elements that we're going to have to look at in the next coming few years. Again, I'm not saying let's not focus on compliance elements coming into bank systems. That's very important. But I think that the regulatory family, and I think that that those that administer our laws are going to have to understand basically and fundamentally how the consumer is being affected. It is our belief at the ABA that the success of a regulation has to be how well it protects the consumer, how well it informs the consumer. Protection has two aspects. One is stop shenanigans on the street. The other one is inform the consumer well so that the consumer can protect his or her interests. That element, Tom, I think is very important. I don't have the answer to it, but it's something we're going to be focusing on keenly over the next several years.
Brad and Adam, in the future regulatory environment, how can we timely and effectively provide rules and regulations while at the same time meeting due process requirements?
So there's a lot here. I think I want to start by saying, just because of the time I've spent working with the industry and various places I've spent time, I don't believe that I don't believe that Russell vote necessarily speaks for the banking industry. I think there's a gap there. I want to think that, to be honest. So going forward, there's a lot of change, and I think there's going to be some discomfort. We can expect that there will be an effort, of course, to have to restaff the CFPB, restaff the Prudentials, restaff with subject matter expertise. That'll be essential to having real rulemaking. And when you talk about the APA, the duration of time that it takes to start, initiate, seek public comment, write a rule, write a final rule, that's a long time, right? We have to staff up agencies, and if their view is we have 4 years to do this, they aren't going to staff as many people. They're probably not going to staff the market monitoring. They're probably just going to skip on that. They're going to focus on enforcement and rulemaking. That'll be what they do. So does that work? I think what you'll actually see is the states have been activated, and they'll be busy, and the federal government will be attempting to do things. So be careful what you wish for. That's probably where we're going. Relatedly, I want to mention the Congressional Review Act. I think that's been damaging, right? You go through 3, 4, 5 years of rulemaking, thoughtful rulemaking, and then in one afternoon, it's reversed. Fundamentally, that is deregulatory, but it also, you know, a lot of people in this room worked on True Lender, and then that was reversed, right? Is that the outcome we want? Is that thoughtful? I don't think we're getting where we want to be. And then regulatory parity, I think we have to mention that here. You know, the payment app rule, I was really surprised the banking industry didn't exert more influence to prevent that from happening. But now we have a system where some types of payment apps receive supervision and other ones don't. And that seems like, again, we're talking about scams. We're talking about our ecosystem, which is, I don't think we can go back to simplicity. I think the ecosystem is getting more complicated. So, yes.
Yeah, I would add that this pendular swing from one administration to the next really isn't helping anybody. It's not helping financial institutions. It's not helping consumers. I totally agree with Rod's comment that we really, when we pass a rule and as part of the APA process, we really should be looking at, is this going to help consumers? There should be not just a cost-benefit analysis, but there should be like a financial health of the market analysis that goes into the process. So you had this period under Biden, you know, where you had circulars coming out from the CFPB and other forms of guidance that really didn't go through the whole APA process. And now you've got executive orders doing regulation. And I think what the industry needs and what consumers need is rules that can go from one administration to the next and be followed, and you know where you stand. Even considering myself somewhat of an expert in areas of consumer protection, I had to sometimes look up, like, now which rule are they, you know, is enforced on, like the Community Reinvestment Act? We're back to 1995. I mean, after 2 failed attempts by 2 different administrations to put out a pretty basic, like, let's update the Community Reinvestment Act rule so that it's in modern times. It's considering digital marketing. It's considering where banks actually do business. Now we're back to 1995, a rule that's outdated and really doesn't address consumer behavior. So Rod and I were talking last night about maybe we need negotiated rulemaking where you get industry and the advocates at the table together, and each side feels like it has its feedback amply considered. There's a resolution. There's almost a tacit agreement, like we're not going to sue in the Northern District of Texas or whatever favorable cherry-picked court that you can find to stop the rule. That just serves nobody. And so, again, I think we need to have a process that focuses on consumers. One thing I would I think we need to also find the right balance between financial literacy and the regulators being a backstop. I am a bit concerned about a caveat emptor kind of approach to, like, really financial literacy is the solution and consumers need to be well-armed, and it's really totally on their backs to look out for scams. I mean, that's not appropriate either. You need a strong Federal Trade Commission, CFPB, Department of Justice, enforcing the laws that are on the books. And so we need to find a better balance in the way we put out rules and regulations.
Tom and JP, can I just jump in with quick agreement, actually? I mean, I think that one thing I want to emphasize is that even prior to the election, CBAs we aligned on messaging on what we wanted for the CFPB, and we said we thought it should be credible and durable. After conversations with the bankers, we added stable, right? And so that has been the kernel of our messaging through all of the tumult that we've seen recently. Regarding the CRA, I worked on a rule at the CFPB that was one of the first to get CRA'd, so the arbitration rule, and we lost by 1 vote on that. But the thing I would note is that that rule was premised on a study that Congress mandated in Dodd-Frank, and through all the years and all the fighting over that, no one has peeled back any bit of the data on that. When we look at the overdraft rule, by contrast, you talk about a negotiated rulemaking, that's kind of what the APA is supposed to be, right? You're supposed to get public comment, hear from folks, respond to those comments, and address them. There was, at least from our vantage point, there wasn't a sense that comments were being heard in that process. And we were finding huge holes in the data. Like I look at John and I tease him because he's got an army of economists over on his side of the street at BPI. I've got a guy on my team, and he's great. James is fantastic. And we now have another person that started a month ago. But we were finding major flaws in the data, right? They were huge, like they hadn't accounted for the loss of credit to folks. They hadn't accounted for credit invisibility when they were looking at the data there. And they didn't address that in the rulemaking, which is why we ended up in the CRA space. And so it's hard. I do agree with this aspiration of kind of getting back to basics. I don't know if we need to reinvent the wheel or just kind of come back to the APA, but we have to do it faster and more rigorous, which is going to be harder.
So let me follow up on that, Kelvin. And you guys talking about amendments of these rules in the 90s is making me feel like a dinosaur having worked on them in the 70s, but that's another issue. Kelvin, this month's, the March-April issue of MIT Technology Review has a red cover, and the entire 82 pages are devoted to cybersecurity threats. And if you want to be scared out of your wits, read that issue of MIT Technology Review, because it supports the view that vulnerabilities online are growing at twice the rate as solutions. And that's not a good end. And so the question for this panel and for you, Kelvin, is what does that mean to the creation of rules in the future? And with agentic AI and the developments AI are creating, and you've all read these articles about AI doing things it wasn't programmed to do, including protecting itself. And people don't even know how that's happening. The experts don't know how that's happening. What does all this mean for consumer protection in the long run or even in the short run?
Gosh, that's a hard question, Tom. I mean, I think part of it is that I think there's a role for regs, and Adam likes to tease me because I always talk about my favorite reg being Reg E, where 50 years ago Congress came up with a pretty bright line with EFTA saying we should always protect negligent consumers. The Fed at the time took that and wrote a rule that was relatively simple that now our whole economy rides on, right? Like I got hacked twice in the last month, embarrassingly, and I continue to use my credit card because I know I'm protected. Well, that's Reg Z, but I know I'm protected because of the systems that we put in place. And the private market kind of took that a step further. But that was a simple rule with a relatively basic framework. And then we had the private sector come in and come up with payment system rules, chargeback protections that went further in protecting consumers, that required complex systems like interchange that involved merchants and networks and banks working together. So when we handle things like agentic, we're going to have to work together to take down like the low-hanging fruit, right? To identify these issues, to solve what we can solve, and then figure out what are the really hard problems that we then need to take up the mountain, right? And I think we can do it. We just have to do it. Otherwise, we run the risk of having some really kludgy and problematic regulations.
To follow up on that, JP, before you ask the next question, there was an interesting article in Wired magazine last month about romance scams, right? And there's a case in which some person, a man, was built out of his life savings by somebody he thought was a woman that wanted to marry him in Thailand. And he's suing the bank for allowing that wire transfer to go through, which raises a whole number of issues, because the bank's basically defending by saying, we're not in the business of being home monitors for our consumers, right? But it does raise the issue of a new set of potential liabilities in this world, because the romance scam business in the Wired magazine, and you should read that article because it's really, again, another scary article. A guy went for a job interview in Bangkok. He was told that he had the job, but he had one more set of interviews in Thailand. They put him on a boat down a river, took his passport, and they said, for the next year, you're working here running romance schemes, and you don't get your passport back until you do. And they said, well, we're going to pay you every day, but of course the payment wasn't large enough to offset what they were charging him for lodging and food. And there's this new, level of indentured servitude being created by all of this, which just in my mind says, my goodness, we're in a much different business of consumer protection than we ever were before. That's just an aside, I guess, but I mean, these things sort of resonate in my head, and I say to myself, I know the business, I know the rules, I don't know how to protect people in these kinds of situations. JP?
Rod, how does someone distinguish between a rule that's poorly implemented and one that's fundamentally flawed?
Okay. The poor implementation, I guess, will have to deal with a focus on the agency, right? And I think that the fundamental flaw, Brad, if I may follow a lot of what you're saying, and I think what's being expressed in this panel is, how is the consumer affected? How is the consumer, first of all, well protected? And number two, is it causing costs that are outsized so that the consumer is actually getting a bad deal in highly priced products? Okay, so leaving that aside for a minute, I mean, let's look at, whether or not the agency, number one, has enough resources to enforce the law. Please do not pass laws that cannot be enforced. Please don't just put laws in the books that are just going to be there for decoration. They have to have an impact. They have to have an effect, right? So can the agency enforce it? And does the agency have enough resources to enforce it? So I think I would use that as a primary measure. And to the extent that they can't, then we'll need to sort of resolve and add elements and resources and other things so that the regulations actually have an impact. And then number two, I can't stress enough the fact that the number one job of an agency isn't necessarily to constantly regulate and constantly impose more regulations on the books. It is also to assess the impact on consumers and whether consumers understand what they're reading in terms of what's required, and whether or not the markets are gaining from the type of information or from the types of structures that are being set out by regulation. It is a fundamental, I think, duty of the agencies to do that. So let's stop this element, this sort of understanding of a regulator as the mean bad guy with the paddle. Let's also look at them as the sage on the hill, that they can come and assess what's happening in the market. How are consumers affected? So I think that this question really sort of has a premise on the process and how we engage in whether a regulation is effective, how we engage into whether a regulation is flawed. I think that has to be a constant analysis. And by the way, the answer to that will change over time because of the developments in the market.
If I could add, I mean, in the wake of Loper Bright, there's still a strong role for agencies to provide guidance too. And I think a rule to be implemented, you still need some deference, maybe not Chevron deference, but still courts are going to look to what the agencies have to say that have expertise in this area. So case in point, HUD in its disparate impact rule saying, oh, we're just going to take effects test language out of the rule entirely, and we're going to abdicate our responsibility as the premier housing agency in the country to provide any kind of guidance on disparate impact. That's a cop-out. You need agencies to step into the fray and at least provide some guidance.
Yeah, it's an interesting point, Brad, you make about Loper Bright and Chevron deference. And last night at our speakers dinner, I voiced my opinion on that, and I said, I may be the only one in the room who litigated before Chevron. I did all the APA cases at the OCC up until 1981 when I left in the 70s and early 80s, and I didn't have Chevron. And I can tell you, I never lost a case on an administrative issue. Why? Because the judge called counsel up to the bench before the motion was argued and said, look, I don't know bupkis about this subject. All I know is there's a bank, a big building, it's got columns, that's all I know. And unless I hear differently about what the regulator's done, I'm going to rely on you, me, to tell me what I ought to do here. So there was de facto deference. I don't think we lose that in the process. What we gain in the process, perhaps, is now more people will be eager or willing to sue administrative agencies over what they've done. I don't think the deference has changed that much at the margin. So we'll see what happens there in the long run. Brad, there's a lot of buzzwords in society and social media these days: inclusion, financial health, innovation. How do those affect consumer protection these days? Are they being wound into the process of consumer protection, and if so, how?
Hello? Yeah, there we go. It goes back to finding the right balance between encouraging innovation, but not making words like inclusion toxic. I mean, it's good for business to have inclusion. It's good for business to have a broader consumer base and not be exclusionary. And so one thing that I worry about now is access to consumers to the system. I mean, the CFPB Consumer Complaint Database, Adam can speak a little bit more to that. I mean, the percentages of actually a consumer getting a reasonable or understandable response from industry lately has decreased greatly. You don't have access to administrative law judges at HUD and other agencies because of budget cuts. So now if you're a consumer, you're left with the choice of either spending tens of thousands of dollars to hire an attorney to protect your financial health or to address a legitimate concern that you have about a practice. You can't go to the CFPB and get quick help from them or the Federal Trade Commission for that matter anymore. So I do think these words like innovation, inclusion are important to financial health, and it goes back to this idea as when we put out rules, when we have agency missions, we need to include some kind of financial health scorecard as part of the sustainability of a program or a rule or a product. That needs to be considered. Adam?
Adam?
So I have two thoughts. First, some questions. So how many folks here have a phone and they, they've left a voice message on it? Their voice. Okay. How many people have someone in their life, could be a loved one, that trusts them for financial advice, or at some point in time, maybe an aging parent, you expect that they will at some point rely on you for trusted financial advice? Okay. How many people know how voice cloning works? How generative AI can essentially take your voice message and help you to call your mom, or could help a scammer call your mom and quickly give them an urgent message about something they need to resolve, right? That's no amount of financial literacy is going to help your parent there. No amount. So first I wanted to say that. Then I think we need to pay attention to how the landscape in our society is changing. And again, this is a little bit of a financial literacy point. Who's aware of what the idea of an influencer is? And then within that space, the finfluencer. So that's the kind of person who goes on YouTube and generates kind of an image. The one that I'm thinking about that is kind of the signal moment is Mr. Beast, and they've recently acquired Step, right? So they're moving into this space of integrating finfluence to actual product recommendation engines. If you think about it from the bank perspective, you've worked with Google Ads maybe, where you had a strong level of control over the message that the consumer received about what your product did. Well, finfluencers have a brand, they have an image. They're gonna say, yeah, well, but what I do is blow things up and give people $1 million, and then they trust me for financial services. That's how you'll have to reach people, right? I mean, it's ridiculous. But this is gonna interact with the landscape changing where financial nihilism is becoming a real issue, especially for younger people. They don't see a prospect in their life where they're going to pay off their student loans and buy a home. They just think the odds are stacked against them. So they're jumping into things like crypto. They're jumping into prediction markets. And they're gonna make these decisions. And a lot of these people watching you blow things up for $1 million are admittedly men under age 25. So we know the level of sensibility there, right? So that's how things are going to change. We don't have a media that's as robust as we used to have, so getting financial advice through traditional sources. No one's reading the Wall Street Journal, right? So this is, I think, an emerging issue. It will certainly overlap with UDAP when people are accessing your product through Mr. Beast, right? Like a lot's changing here, and I think we need to pay attention to the landscape, the ecosystem.
Okay, so we've sort of critiqued a lot of areas of regulation, maybe criticized some. Rod, you've been at the ABA for 120 years or so. Give me some examples of successful regulations in this area.
Let me be completely, I guess, controversial and maybe face the ire of my own members if they're watching this event, as they are. Let me say that a big success has been the ability to repay rule and the qualified mortgage rule. It's a rule that hit us and completely sort of put us in the defensive, and it changed our role in the transaction. We banks used to be the financiers of our communities. Then suddenly we became rule followers in how we had to underwrite. It's the first time that a law came in and actually imposed certain underwriting sort of strictures and rules upon the financiers, upon those that had served as financiers forever, all right? Now, the problem, the background, however, is that we were coming out of of a huge crisis. And this rule came in to sort of structure the process and structure how it is that we need to correctly engage in underwriting. That's number one. Number two, it also came in and allowed the agency, forced the agency to actually interfere at various points so that it could continue to upgrade and calibrate the rules of ability to repay. I would say to all of you and to my members that I know may criticize me on this, we need more calibration. And we are pushing the agency for more calibration. We will ask that it be liberalized a little bit more. But in terms of success, it came in to sort of calm a confusion that was happening in the market at that point, calm markets that were also spooked at that point, and the agency did, I will give them a B+, maybe an A-. I never want to give them an A-. B+. That's a damn good grade. In getting that rule out and actually controlling the abuse in the market, Tom. So with some amount of controversy, I'll say that was a good rule.
Is that B+ marked on the curve?
Yes.
And how about between the implementation and the rule itself?
The implementation, well, the rule itself, of course, allowed the agency to engage in some definition of what would become a safe harbor. So I would say that the implementation was good. I think that the CFPB did listen. They did engage with us. They did have a conversation also with consumer groups. But I think that we came to a good place. I'll tell you, we're hearing screams for liberalizing, but I think that up to now it's worked well. And I think in that sense, let me just take half a minute to highlight something that Brad said. There is this concept of a negotiated rulemaking, which involves the bringing together of all the parties in a room, all interested parties, including civil rights organizations, consumer groups, lenders, insurance agencies that may have a stake in the transaction, and engage in a conversation at the pre-rule stage about what kind of rules what the rules should look like. They come to an agreement before the rulemaking begins that then becomes, to the extent that there's an agreement, becomes the proposed rule that is issued to the public. So it already is a well-digested system of regulation that is imposed at the proposed rule stage that then really becomes an easy way to just sort of sculpt out the perfect shape of whatever it is that you are creating. So in that sense, I think that to your question about what has been successful, I would say the QM rule, simply because it was allowed to develop and have a different shape. And I will say that should be the process going forward, which is a lot of collaboration with all groups.
Thank you. Kelvin, what is the most significant consumer protection issue that you think is not receiving enough attention?
Oh, that's a great question. I'm going to go broad and just say broad consumer protection outside of bank reg, outside of CBA's remit. But if we're in this world where consumer financial health spills over into regulation in our space, and if we're going to get into fights over saving consumers $24 a year on their credit cards, I'd say sports gambling, right? So if you look at well, to be specific, mobile sports gambling, because the data and the research that's coming out is showing that that's different. Mobile sports gambling, dollar for dollar, displaces savings rather than consumption. We're seeing just huge upticks where I think Pew found that 50% of men under the age of 50 have placed an online bet. The NCAA found that 2/3 of men from 18 to 21 have placed an online bet in the last year. And if you're doing like an actual mobile online sports house, it's a market for lemons. If you're a perennial winner, they will shut you out. So you can only keep doing this if you're a loser. If we're talking about the prediction markets, and I know that that's a live rulemaking, that's another thing, but I would note 90% of their revenue is sports gambling, and you don't get the benefit of at least the state having weighed in and kind of reaping in the state taxes that presumably they've made the trade-offs for sports betting. So I'm not trying to throw sharp elbows, but banks tend to kind of catch a lot of fire when consumers have shocks outside of their lives. That's just a big hole that's tearing into consumers' financial lives where people already don't have slack, and I just see a truck coming at banks afterwards to somehow be responsible for this.
So all of these brilliant people out here are also consumers. So let's get some questions from our brilliant consumers. Kelvin, you talk about, and the last panel we talked about predictability, and talk about online gambling. As a public policy matter, I'm not sure why we need more gambling in this country, but that seems to be the direction we're going in. And when I was a young litigator, I had a case in Atlantic City. I had a case in New Jersey, and I deposed all the bankers in Atlantic City because that's where the bank was. And I lived at Resorts International when it was alive for about 6 months.
Yeah.
And you go into the casino and you say to yourself, these people shouldn't be here. They just shouldn't be gambling here. And I don't know why we have to extend that, but I guess that's just the nature of the beast. Questions for this group?
One of the questions I've had over the years is why the transactions are always so permanent and fast. Like, it seems to me that a lot of the fraud happens, and you can see it in the movies, like, oh, the money's already transferred into 42 offshore banks, we'll never get it back. But we have the transaction records. We should be able to roll back a lot of these things. And it strikes me that one of the simplest consumer protections is to make a more efficient clawback mechanism that can go in and maybe unwind. I mean, maybe there are 1,000 transactions and it's spread across all these offshore banks, but the system, since it's strong enough, should be able to roll these things back, I would think. And so I don't know, do you guys think that's the case, or are there other things that I just don't realize?
I guess that's me.
Yeah.
Or unless anyone else wants to take that.
I have something to say.
Yeah, you say it, and then that'll be like the strongest, meanest case, and I'll try to rebut that.
So we kind of have that debate process in checks, right? I mean, but that's slow, and the two institutions argue with each other, so it's not working perfectly well. I think a vulnerability is the receiving bank, right? The one that is the bank of the criminal, right? That's where the problem is occurring. If you're the sending institution, you don't know who has the account at the bank of the criminal, but the bank of the criminal is seeing that activity. And to the extent that enforcement, maybe that's an alternative to EFTA changing for sending payments and liability, to the extent that enforcement can be used to refund consumers when the bank of the criminal was the vulnerable point and they ignored the problem, that's on my mind.
Yeah, so it's a great question, and I want to be careful to not get over my skis here. I think a lot of this comes down to the type of transaction and the type of protections that we'd expect to have in place, right? So when you think about a credit card transaction, those are wonderfully reversible. Like, you have chargeback rights where if you're dealing with a scumbag merchant, like setting aside like Reg Z and all those protections, you have private sector provided zero liability guarantees that'll make sure you're always whole, because we want to make sure you feel comfortable continuing to use the system. In other areas, though, for other types of transactions, there are questions about whether or not it's within your financial service provider's ability to see whether or not that transaction should be reversed or not, right? And so the way the regs have been set up is that if it is the split comes to whether it's authorized or unauthorized, and I should be really good if I'm a bank, at knowing whether or not it's actually you. And despite all the voice authentication and all the sneaky AI, we'll take it on ourselves to make sure that we know that. And if it isn't actually you, then gosh darn it, it's on us, and we'll work with you to make you whole. However, once we know it's you, and you've been defrauded from something outside of that world, we can't see if Adam told you that he loved you and he really loved you or he didn't, right? We can't tell you, like we can't see whether if Adam gave you puppies or didn't have puppies, or if Adam told 50 people that he loved them and had the same kind of transaction going on. Like we can't see that, and so we can't really be responsible for that. The good news is that there are people that can see that. And so one of the things we're trying to do right now is to work with consumer groups like Adams and others to try to make sure that we bring those folks into this conversation so that we can get their information and their data and their skin in the game and trying to make consumers whole.
So Peter and I have sort of discussed this issue many, many times about the immediacy of transactions that we're moving to. And so let me just tease the panel that Peter's going to be on this afternoon on tokenization a little bit here, because it's pretty curious to me that in the 1800s to 1860, right, we had a segmented monetary supply system in this country with private money, right? We had a lot of private sources of money. Banks issued their own notes. The Monongahela Bridge in Pennsylvania issued its own wooden nickels that not only were used for the bridge, but were used for the general store in town. And by the time we got to 1860, a few things happened. We issued greenbacks to finance the Civil War, and the control of the currency was chartered in 1863. And we decided that these systems didn't work. We need a federal system of money, and meaning not private money. And we started to develop a system of trusted intermediaries, ending with the FDIC perhaps as the ultimate trusted intermediary. And the interesting thing is now, because of technology and because entrepreneurs are pushing technology, the pioneers, we're now saying, well, let's go back to private money. And let's go back to the days when things weren't immediate. And let's go back to a point where we had no trusted intermediaries. And I just wonder if the last 100 years were wasted trying to build these systems that we're now trying to unbuild. It's a fascinating sort of analysis when you think about it, that we've spent 100 years building a system we now think we have to dismantle because of technology. I doubt that that's right. I know that technology wants that to happen because technology makes money from that happening, but in terms of public policy, I wonder if that's the right answer. So with that, let me ask you to thank this panel for a terrific discussion.
Tom.
Sorry,
I think we
JP.
might have one question.
Oh, okay, I'm sorry.
One quick question. When we look at first-party fraud or friendly fraud, which that's when the consumers are using the consumer protection laws to commit fraud themselves, we've got influencers, I can't even say that, showing consumers how to do this. There's surveys and data that anywhere between 30 to 70% of consumers have filed a false Reg E claim. How do we create consumer protections that are going to protect the consumer, but also protect the banks from the consumers who are fraudulently using the consumer protections?
Oh, that's a good question.
That, Adam.
So CFA doesn't defend fraudsters. Doesn't matter if you're a consumer or a traditional fraudster. So I'm certainly sympathetic to this problem, but it's a very different problem, right? And it hurts small businesses. There's no doubt about it. So it's a real problem. It's just I think to conflate the two, that's not where I think we want to put our time. We're worried about people getting hurt, not hurting other people.
Thing at the end, and that's if we're rebuilding a consumer protection system, the industry shouldn't be like vampires and be afraid of like, oh, not sunshine, no sunshine. We've had HMDA in place in Reg C for all these years. It's worked remarkably well as a tonic. The companies that do lending well get credit for it. Those that need to do better to help to improve their stats. We need to do the same thing with small business lending. So these sunshine statutes are rules that need to go in place right away if industry is going to try to get this right.
I think that's extremely important. I also think it's important that we stop writing regulations with 1,000-page preambles, because I can't even read them. And with that, let's thank this panel for a terrific discussion.